Let's look at our first question for consolidation of income statement. Look at this question. This is Hepburn. On 1st October 2013, Hepburn acquired 80% of the equity share capital of Salter by way of share exchange. Hepburn issued 5 of its own shares. For every 2 shares in Salter, the market value of Hepburn shares on October 1st, 2013 was $3. The share issue has not yet been recorded in Hepburn books. The summarized financial statement were provided. Remember, we've solved the statement of financial position part of this question in my previous recording. Now we want to look at the income statement part, right? There's the other part of the questions where the financial statement were given and other notes to account were also provided. We have note B, C, D, E, F provided. We've looked at them before. Note B is on fair value adjustment on land. It is not a depreciable asset. In that case, would not affect our profit or loss account. C is on post-acquisition sales that was made by Hepburn to Salter for $100. The markup 25% was provided, and half of those goods were still in inventory, which means there will be a consideration for unrealized profit at 50%. Likewise, note this says that goodwill has been impaired by $20,000. And look at these questions. If you go to note F, NCI is measured at fair value, which means this impairment will need to be adjusted for in the subsidiary financial statement. So we'll need our goodwill impairment. Need to take note of that. Yes. And note E is on intercompany AP and AR. So that would not also affect our profit or loss account. So we're going to stick to our style. And our style is to first of all check if there has been acquisition during the year or at the beginning of the year. For this question, we can clearly see that this acquisition was made during the year, because look at it, it's just there. The action was 1st of October 2013 and the year end is 31st of March 2014. So that is October, November, December, January, February, March. That's 6 months before the year end. And in that case, we will need to adjust for time difference, and which means we're only going to consolidate 6 months of the subsidiary figure. So that's the first thing we need to do, and that's what I'm doing now. So I'm starting with the subsidiary adjustment. Remember, revised subsidiary financial statement, we need to do that. So for time adjustment is the first thing, so this will be 500 because this is full year. Yeah, remember 1,000, like all of this column, that is full year. So we need to divide that column by 2. So this will be 330. This will be 44. This will be 6. I'm going to come back to goodwill. That's other adjustments. But the first thing is time apportionment before we go into other adjustment. And this will be 20. If we add all of that together, that is 500 minus 330 minus 44 minus 6 minus 10. That gives us 100. Let me be sure. It's 110, I think. Yeah, let me just do it again. 500 minus 330 minus 44 minus 6 minus 20. Actually 100, yeah, because it should be half. So I'm wondering where the mistake is coming from. So that's 100. That gives us 100. So which means we have apportioned based on time. But that is not our revised financial statement. We are not done yet until we check for other adjustment that we have to make. That's when we know what exactly is our revised profit. Okay? So in this question, there's intercompany sales. However, the sale was done by, let's see, in note C, Hepburn sold goods, so it doesn't affect this financial statement. There's no adjustment on revenue or cost of sales that we need to make because it was not salted as sold. This is salted that we are looking at subsidiary. Remember, we are looking at salted adjustment. We will also adjust the parent after this. So the only thing we need to adjust for here is the goodwill impairment because they have told us that the NCI is measured at fair value. That means the goodwill impairment must come into the subsidiaries adjustment. And that impairment was given to be 20,000. Yeah, so which means we need to put 20 here. And in that case, that's the only thing that needs to be adjusted for. Every other thing remains the same. And we have a revised profit to be 100 minus 20, and that will be 80. So that is it. So the final FS for subsidiary will be 500, 330, 44, 20, 6, and 20. And that will give us 80. That is it for subsidiary. The same process we have to do for the parent, Hepburn. We need to adjust. I'm going to list similar items just as I listed above. Remember, when you are doing consolidation, you don't need to be doing gross profit. You can save your time on all of that. Yeah. We won't have goodwill impairment here because the goodwill is not measured at profit. The NCI is not measured at the proportionate of net asset. So no goodwill for parent. So we have the venture interest. We have taxes. I think that will be it. Right, so we need to bring it for parents. That is originally we have 1,200. We have 650. I'm going to leave space here because of those adjustments that we'll have to make. So yeah, just leave some space there. Okay. Operating expenses is 120. There's no debenture interest for parents, and there's tax for 100. So nothing here, and tax of 100. So all of that will give a profit for parents at 1,200 minus 650 minus 120 minus 100, 320, 330, sorry. So that's the original profit that we have. We don't need to do apportionment. You don't always have to do apportionment for parent because his parent is the one acquiring, right? So we can go straight to the adjustment for the parents now. And that takes us to those notes to the financial statement where we were told about intercompany transactions. So the first one is that note C, because Hepburn sold some goods. And if you remember in our previous recording, we calculated unrealized profit in this one to be 20. So the total profit to be 20, unrealized profit is 10. And I can quickly remind you how we do that. So let me quickly show you. Remember, markup is always 25% is given, multiplied by the cost of sales equals to profit that we don't know. And likewise, the selling price minus cost of sale equals to profit. We know the selling price, so which means 0.25 of cost of sale is the same thing as 100K minus cost of sale. In that case, 100K equals to 1 plus 0.25 cost of sales. And cost of sale equals to 100,000 divided by 1.25, and that gives us 20,000. The question says that 50% of that good has not been sold, which means that 50% of our profit, equals to 80K. So if cost of sale is 80K, I'm just which means profit is 100 minus 80K. Because selling price is 100K. So profit is equals to 20K. So unrealized profit is 50%, because 50% of the goods has not been sold to third party. So that equals to 10K. Right, so take note of that. We'll deal with it. The first thing we need to do is to adjust for the intercompany revenue. And that is usually done both in the revenue side and in the cost of sales side. So intercompany sales, we have an adjustment. We need to deduct. It was sold for how much? It was sold for 100,000. So the whole of 100,000 will be taken away. Please, it doesn't matter whether half has been sold or a portion has not been sold. You need to take away the effects of that transaction amongst the group. So we're going to deduct that 100K from the revenue, and we're going to also take it away from the cost of sales. Because it's in brackets already negative, that's why I'm not putting negative here again. So please take note. I don't want to get confused. Right? So our revenue will be 1,100 with that. For cost of sales, we've adjusted for intercompany sales of 100K. There's also provision for unrealized profit that we need to add back here. And that means we need to increase our cost of sales by 10K. And that will give us a net cost of sale of 650 minus 100 plus 10. And that's 560. So we have cost of sale of 560. For operating expenses of 120, it remains the same because we know goodwill has been treated under subsidiary adjustment. There's no interest on debenture, so it stays as it is, and taxes remain as 100. And in that case, we have a final adjusted parent profit will be 1.1 minus 560 minus 120 minus 100, and that gives 320. Okay, so now we have our adjusted profit or loss account for both subsidiary and parent. Now the second step in our process is to consolidate, which is to add together. So we're going to have a list as we usually have it. Revenue, cost of sales, OPEX, operating expenses. Our goodwill impairment, did we add it to OPEX or is it a different line? It's a different line, so I'll bring goodwill impairment here. So goodwill impairment will come there. Venture interest as well. Then we have taxes. So now we're going to have revised subsidiary, revised parent, and we'll have group, which is the addition of the two. So I like to break it down like this. After you have perfected the process, you can start lumping them together easily, but it's good to start learning in a less convoluted way, in a simple way, where you can easily see what we're doing and how we're achieving what we're trying to achieve without any stress. So for subsidiary, which is this, the revenue is 500. I bring it down. That's a revised subsidiary. It's 500. The cost of sale is 330. Then we have 4426, 4426. Is there another one there? Then we have 20 as tax. And that gives us the revised profit for subsidiary at 80. For parent, likewise, we have 1100. We have 560, 120, and 100. And that gives us 320. At this point, we are ready to consolidate. It's now pretty easy. All we need to do now is to just add together. So this will give us 1,600. If you add 330 and 560, we have 330 plus 560. We have 890. Then OPEX, which is 44 and 120, we have 166. So we have OPEX of 164, sorry. And this is 20, means 6, but there's nothing here, and 120. And with this, we can get what our final group profit is. So that's 1,600 minus 890 minus 164 minus 20 minus 6 minus 120. And that gives us 400. So 400 is the group profit. 400 is the group profit. And it's as simple as that. The third stage is to split the profit to NCI and parents. Remember, third step, split profit to parent and NCI. So which means we need to calculate NCI profit, which is equals to, because this is just 80% ownership, NCI will have 20% of its revised profit. So that's 20% of this 80. See why it's important to have your adjusted FS. Yeah, and that will give you 16. The parent profit is the balancing figure. That is 400 minus 16, and that is 384. That's why the total will always be 400. And that is it. And you are done with this question. Prepare a consolidated statement of profit or loss and statement of financial position. We've done statement of financial position in the previous reading. Now this is the consolidated statement of profit or loss for this question. And that is it for Hepburn. I'm going to solve another question in the next recording, still on consolidated profit or loss and other comprehensive income. Keep going, keep liking, keep subscribing, keep sharing. Comments if you have any question. If you like it, likewise, your comment is good. Keeps me going. And bye.